Right now the S&P 500 is hitting all-time highs. Your portfolio probably looks great, and it really feels like the good times are just going to keep rolling. And yet, the world's most successful investor is quietly, very deliberately, making a move that signals something completely different. So let's break down exactly what that signal is. Let's start with this number, $348 billion. Just let that sink in for a moment. That is the amount of cash Warren Buffett is sitting on right now. To put that in perspective, that's more than Apple, Amazon, Google, and Microsoft have on hand combined. So the critical question isn't just what he's doing, it's why.
And make no mistake, this isn't some passive thing. This is an active, deliberate strategy. For 10 straight quarters, Buffett has been a net seller of stocks. He even sold off 2/3 of his position in Apple, a company he once called the single best business in the world. And he built a very similar war chest of cash right before the last major market downturn. He's sending a clear, undeniable signal.
So let's dig into the 3 major red flags that people like Buffett are seeing right now. Because in this kind of environment, all-time highs aren't necessarily something to celebrate. They can actually be a huge warning sign.
Okay, red flag number 1 is a classic. It's the one that trips up almost every investor at some point, paying way, way too much for assets. We're talking about extreme valuations pretty much across the board.
And to see this clearly, we can use Buffett's own favorite metric. It's actually called the Buffett Indicator. It's a really simple idea. You just compare the total value of the stock market to the country's entire economic output, its GDP. You can think of it like a price tag for the whole market.
Now, here's the kicker. Historically, whenever this indicator has crossed the 200% line, a bear market has followed. Right now, we're at 221%. We are not just in the danger zone. We are well past the point that has historically triggered a major correction.
The second red flag is all about the market's incredible lack of diversity. All of its success is concentrated in just a tiny handful of companies. And what that does is create a very, very fragile foundation for the entire S&P 500.
Get this, just 7 of those mega-cap tech stocks were responsible for over half, 53% of the S&P 500's entire return last year. This is literally the highest market concentration in recorded history. What that means is, if just 1 or 2 of these giants stumble, they could absolutely pull the entire market down right along with them. And that leads us to the third and maybe the most telling red flag of all. It's about who is quietly heading for the exits. See, it's not just Buffett. The smartest investors out there are systematically reducing their risk. They're voting with their dollars.
You take Michael Burry, the guy famous for predicting the 2008 crash. He has taken an unbelievably defensive position. Right now, he's holding just a single stock and is sitting on almost $2 billion in cash on the sidelines.
It's the same story over at the major hedge fund Third Point. They've completely sold out of huge popular names like Tesla and Meta, and they're trimming back their positions in other giants like Amazon.
And then you have a legend, Stanley Druckenmiller, doing the exact same thing, cutting his exposure to big tech across his entire portfolio. Look, when you see a coordinated exit like this from the best investors in the world, that's not a coincidence, that's a consensus. So what does this all mean for you, for your portfolio? Well, it really just boils down to the price you pay. Your entry point into the market can have a dramatic, almost unbelievable impact on your financial future. Let's actually quantify it. Okay, let's look at 2 paths. In scenario A, you invest $100,000 today, right at the peak. With an expected return around 5%, that might turn into about $162,000 in 10 years. But now, look at scenario B. You wait for a 20% correction. Your entry price is lower, which means your expected return jumps to 12%. That same $100,000 now grows to over $310,000. The difference is more than $147,000, just for being patient.
Now, this is not a reason to panic. Not at all. It is, however, a reason to be strategic. So let's talk about a defensive action plan. How to prepare your portfolio without just running for the hills and selling everything.
First, build up your cash position. You can actually get a pretty solid risk-free return while you wait for better opportunities. Second, think about rotating a piece of your portfolio into defensive sectors, things like utilities and healthcare that tend to hold up better in downturns. Third, you can explore strategies specifically designed to protect your portfolio from downside risk. And fourth, and this is crucial, keep a watch list. Know the great companies you want to own so you're ready to buy them the moment they go on sale.
And that brings us right back to Buffett. He isn't holding $348 billion because he's scared of what's coming. Not at all. He's holding it because he is prepared for the incredible opportunity that a market correction will bring. That is the fundamental shift in mindset you have to make.
He sees a coming storm not as something to run away from, but as the exact moment of opportunity he has been waiting for. So the only real question left is, are you?